decent set of first quarter numbers, witnessed strong business momentum, and profits were aided by lower provisions as well. We saw slight pressure in asset quality, but assets under management growing by 29% on a year-on-year basis was the highlight of this result. Kapish Jain, who's the CFO of the company, now joins in to discuss more on their Q1 performance. Kapish, thank you so much for joining in. Just wanted to understand, can you maintain this sort of AUM growth for this entire year? What are you targeting? And at the same time, are you seeing some pressure on your asset quality? Is there any improvement in sight?
So, on the growth side, we have, over the last 5 years, when we have seen COVID and we have seen the liquidity crisis as well, we have consistently grown. We have shown a CAGR growth of around 23% in our core retail segments. And going forward as well, just for this quarter, if you see, we have grown at 5-6% in our core products, which signifies that on an annual basis, we should be able to retain the similar growth trajectory that we have. And this time it's been more broad-based. So it's been similar across products, whether it's gold, housing, microfinance. They all are showing similar trajectory for growth. It means all businesses are coming along together. And we believe that this is sustainable for the precise reason is that the market is fairly conducive. There is a huge amount of expansion that we have done in the last couple of years, which is giving us the opportunity to tap the market by our presence itself. We have enhanced our marketing initiatives as well. You would have seen us coming on televisions through many of our marketing initiatives and ads. That is creating a lot of recall for us from the customers and generating a huge amount of leads as well to move towards conversions. All these aspects is helping us to move towards a growth which we think is sustainable. On the asset quality side, we reported an NPA of around 1.1, 1.8 and a net NPA of around 1%. We believe that that's sustainable. And the reason why it's been happening that we have been able to hold our asset quality is humongous amount of effort that goes in more particularly in the early stage delinquencies, which is more in the PAR numbers, and to make sure that we act quickly and we initiate all our activities with regard to recovery and collection. And that is helping us in getting the asset quality intact. Market again is looking fine and decent. There's better collection efficiencies, better recovery that's happening across. The rural market is also holding fine. And that is also giving a far better number. If you look into precisely only the microfinance business, you will notice that the PAR number for microfinance is around 4.5%, which is very, very impressive and healthy. And when we slice it across geographies, for the major markets where we operate, we say that number is also reasonably decent.
Okay. Kapish, I just wanted to get a little micro when it comes to asset quality. And if you could detail what the trends are in the loan against property segment, along with the home loans. Are you seeing any kind of chinks in the armor when it comes to asset quality recovery?
So, in home loan, so anybody, whoever has a liability commitment to service, the home loan liability is something that is going to serve first. So that way that particular portfolio gets priority with regard to order of servicing. With regard to the LTV factor, that book also holds a reasonably decent LTVs at around 66-65%, which again give enough headroom for somebody from a recovery perspective. So there again, we think that this portfolio will be doing well with regard to recovery. Our own experience with regard to asset performance over the years have shown improvement. We did hit some amount of higher delinquencies during the COVID period and during the COVID phase. But since then and now, with the market improvement, there have been marginal improvement in the overall property rates and rates across pricing in the geography. That is also helping us in the improvement on the LTV factors, with minor reduction in the overall outstandings as well. So we believe home loan should do well, and we should be able to sustain and improve ourselves from our overall asset quality side in the home loan piece. With regard to LAP asset, the biggest comfort that you get in LAP is first it is at a higher yield trajectory, so you have a higher spread coming to you. That's how you right price your credit. And second is the LTV factors in LAP is even lower. LTV factor in LAP largely revolves around 50%, which means you have a higher proportion of asset available to you from a recovery perspective. These two aspects make sure that the customer is going to pay you, and the customer payments also then swiftly walks in to take care of your credit. But the bigger element is that your asset pricing addresses some of your credit cost element that can come in there as well.
That's interesting. Asset price, LTV is a function of that as well. You spoke about the loan to values being 60-65% in your housing portfolio, and LAP is around 50-odd%. Are there parts of your portfolio where the LTVs are higher, say closer to 1? In some cases, some branches. Just wanted to understand your LTV policy there.
No. So even from a regulator perspective, I cannot have a 100% LTV. Right. From a regulator perspective, also you need to follow what the regulator prescribes. So across various prescriptions, the regulator has, some of it is depending on the ticket size. You cannot breach the LTV. So LTV largely revolves around what the regulator prescribes.
On a blended basis, what do you think it would be?
So on a blended basis, what I mentioned, it would be around 65% on the housing side and around 50% on the LAP business.
Okay. Kapish, calculated net interest margins have jumped up quite significantly, 5.5% compared to 5.3% Q on Q, compared to 4.8% on a year-on-year. Do you think that this is sustainable?
So if you notice by asset mix, right, by asset mix, you will see that the gold prices and the gold yields have remained stable, right? In the housing business, we have enhanced our yields. We've been able to pass on some of our increase in borrowing costs to our customers. That is helping us to get an enhancement on our yield, and housing is around 30% of my entire portfolio. The second element is my microfinance business. In microfinance, the share of the entire AUM is around 15%. The regulatory changes that came in last year, just more than a year back, allows now once to right price your asset, which was earlier having an embargo of not more than 10% of your cost of borrowing. Right pricing of your asset in microfinance is extremely important, and that is helping us in yield going up by around 200 basis points overall from what you saw last year, Q1 to now. The blend of that with a higher share in microfinance is helping us to have a higher blended yield in my portfolio as well. The cost of borrowing has not gone up in spite of 250 basis point hike in your repo, and also 150 or 140 basis point in MCLRs, which means that the cost of borrowing is not moving in tandem to what my yields are moving up, and therefore giving me a higher spread and margins. So these are the elements which are playing out. Q1 more particularly, you would have noted that we raised some ECBs at fairly competitive pricing, and we also, more importantly, paid back some of our high cost ECB borrowing that we did in fiscal 20, which is causing us a drop in my overall cost of borrowing as well, relatively to the market. And therefore, we think that this NIM is coming out healthy and is definitely sustainable, because we operate in a space in certain product segments where we have the ability to hike our rates if the rates move upwards.
All right, Kapish, thank you so much for joining in and giving us an outlook on your business. May the growth that you projected continue, and with better margins and better asset quality as well. With that, we take a short break. On the other side, we have the management of Indian Bank, Shantilal Jain, who's the MD and CEO, joins us for a discussion on their numbers.